Good morning, everybody. Please make sure your cell phone is on stun. Okay. And yeah, we used to have $25 fine for cell phone donation to our scholarship funds, but I guess they did away with those. Anyway, so please put your phone on silence and we'll get the meeting started. May I ask the honor of Steve Getz to come and lead us in the pledge?
Your right hand over your heart. Ready, begin.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all. Play ball, yeah. Thank you. And next we'll have Mr. Buck Stapleton, who will give us today's inspiration quote.
Thank you, Brian. How many of you have ever heard of Woody Allen? He's
Yeah.
whatever. Well, he has a couple of good comments on success, and I thought I would just give you part of it. 80% of success is showing up. Deepak Chopra, who I've read this now for the 5th time, adds, and as a real estate broker and a trainer, I often would talk to folks about showing up on time. I learned this: 80% of success is showing up. Deepak Chopra adds, success is a journey. It's not a destination. So good luck in your success and your planning for next year.
Thank you. Thank you very much, Buck. And you know what we always say? 80% of the money in real estate is earned by those 20%. So since we're the 20%, we're the successful agents and we showed up. Yeah. Okay. The next is a little bit about me. See, very little tiny words. So you guys all know me. I'm past president twice, this board. Been here since 1989. Be on the board since 1992. And I'm very, very happy to say I'm not coming back next year. It is my great pleasure to introduce to you our guest speaker today. Oscar is the Deputy Chief Economist at California Association of Realtors, CAR, not car. Okay. A statewide trade organization of real estate professionals with more than 200,000 members. He co-manages the research and economic department and oversees the operation of data analytics and survey research within the division. As an economist at CAR, Oscar provides regular updates on the economy, state and regional housing markets, consumer behaviors, and public policy issues. He has written articles and reports on subjects including housing supplies, affordability, mortgage finance, home ownerships, tax reforms, and other topics related to the real estate industry. He continues to frequent CAR's weekly housing market updates newsletter, contributing, and Housing Matters podcast and Housing Perspectives. His work has been quoted by the Los Angeles Times, San Francisco Chronicles, Kiplinger's, NPR, KFI, as well as other media outlets. Oscar has been with CAR since 2003. Wow, 21 years old. Wow, great. Before that, he worked for a toy company as an analyst to conduct research on identifying kids' trends and evaluate their global implications on the industry. Oscar has a bachelor's degree in economics from the University of California, Berkeley, and a master's degree in economics from the California State Polytech University, Pomona. And let's give a warm WSGV welcome to Oscar.
for the introduction, I should actually shorten the introduction to just say economist from CAR. That actually will make it a lot easier for people to move on. I do have a slide deck that I want to share. I think I have maybe about 30 minutes, 35 minutes-ish or so, and then Q&A. And so, it's a little shorter sometime, sometime I do like a 45 minutes or an hour presentation, but today is a little shorter, which actually might be a little bit better. As usual, I'm going to start off with some information about the economy first, and then I'm going to talk about the market, and then I'm going to talk about the outlook. So let's get started with the first slide. Actually, the second slide. Sorry about that. Now, let's talk about the economy. How's the economy doing so far? Now, this year seems like it's actually getting a little bit better. But, from the audience, what do you think about the economy? Well, things are actually getting a little bit better. Now, it depends on what you look at. Of course, if you look at a lot of time, economists look at the economy based on the economic activity, GDP numbers. Now, I have on the slide on the screen up there, couple graphs. One is about the GDP, or actually one graph and then some bullet points. The GDP graph is up on there. It shows you for the US what the economic growth has been looking like in the past, going back to 2012. You can see there's a spike in the middle. That is 2020 when we had a downturn because of COVID, and then it spiked up significantly in that quarter afterwards. But the recent quarters, we actually have been fluctuating. We actually have been seeing some slowdown from about 3.1, 3.2% to currently about 2.8%, which is still okay. Now, before this year, economists generally expect the US economy to slow down, maybe even go into a recession early last year. That was the expectation. But things didn't happen. It's actually continued to be positive. We're still growing at around 2.8%. If you look at some of the numbers, I think I have some numbers later on retail sales that shows things are actually moving along pretty well. Part of the reason is because of consumer spending. Consumers remain very, very robust. Consumer spending remains very robust. You're probably one of the participants. Remember how many Prime Days you guys have been participating? Usually in the past, it's only one Prime Day. Amazon only has one Prime Day, but this year they probably have 2 or 3 this year. And of course, as a consumer, we look at those deals and we jump in and we probably bought some stuff that continue to sit in the garage that we haven't used. And of course, Black Friday. It's not indicated on here, but some Black Friday numbers I collected in the last couple of days. In the past week, we looked at some numbers. It showed that it actually increased from last year by 3% on a year-over-year basis. That's not accounting inflation. If you account for inflation, the number will be a little bit lower. But of course, in the last, on Black Friday, which, by the way, it's not really Black Friday anymore. It's actually the Black Friday week or maybe the month. And so discount has been going on for a while. And, some of you in the audience probably remember 15 years ago. You don't have to raise your hand. 15 years ago, probably we have to line up like the night before, like 4 o'clock, 3 o'clock, right out at the stores. But I don't think people do that anymore. You can just shop online, and get your deals, the week before. And again, that's great, but at the same time, that makes it easy for you to spend money, right? And that's the reason why, consumer spending continue to be, pretty robust. But it's not only consumer spending. We also have business investment, business fixed investment continue to grow. Part of the reason could be because of people want to get into AI. Some of you may have been using AI to, maybe boost up your technology, maybe help, your marketing. Many of you probably have used ChatGPT. And I've used it myself too. There are some videos, there are some things that we probably will be using AI next year. I'll talk more about that later. And of course, government spending. Government also has been spending quite a bit in the last year and a half or so to actually try to maybe wrap up the administration, the last year of the administration. So you have been seeing some maybe constructions, on the streets and things like that. But overall, things are actually doing okay. And we do expect additional slowdown in 2025. Next slide. Now, the reason why we expect some slowdown is take a look at the slide here. I said, it's easy for people to spend. It's people to, take out their credit cards and just, put it online and just charge it online. Take a look at the slide though. even though, of course, wage growth continued to improve, wages continue to increase. But if you look at, how much people have been charging on their credit cards and whether they are paying or not, this is a slide that shows you the delinquency rate. Now, there are different delinquency rates here. We have mortgage delinquency rate, auto loan delinquency rate, HELOC, student loan, and credit cards. Take a look at the line for mortgage, for example. It's the orange line. It's very, very low. It's at maybe about 1%, 2% or so. Take a look at HELOC, also not really high. But take a look at the auto loan. Auto loan actually starts, increasing to maybe close to 5%. But compared to credit card delinquency, take a look at the blue line right there. The credit card delinquency actually has been rising. If you look at credit card delinquency and compare it to what it was in the first quarter of 2010, that actually is, or not, I shouldn't say 2010, but closer to 2012, that's actually getting to that level now. So we're at a level that is actually comparable to where we were at when we actually had a slow economic growth era. So it's safe to say when people look at those numbers, when people look at their credit card statements, they probably will think, hey, I need to maybe cut back a little bit because I haven't been able to pay my bills. Now, it is also very possible that in the next couple months, we will still see those numbers. But safe to say, I think in the next year or so, we will see some slowdown. Now, of course, there will be some changes next year. We'll talk more about, the election outcome and how it impacts the market as well as the economy. But in general, if everything stays the same based on those numbers, you probably will see some slowdown in consumer spending. Now, the other measure that we want to look at, other than how much people spend and also, economic activity, is take a look at inflation. Everyone in this room probably is an expert in inflation now, right? After a year or 2 years, we have gone through 9% inflation. Take a look at that slide on the graph on the on my right-hand side, the blue line. At one point, it spiked up to 9%, 9.5%, 9.2% or so. But you can also see that in the last year and a half, it started coming down. Currently, the headline inflation numbers include the more volatile item like energy and prices, has come down to 2.6%. The target for the central bank or the Federal Reserve is 2%. So we're getting closer to that level. We're not there yet, but we're getting closer. And we expect next year we'll probably get to a much closer number, maybe 2.2, 2.3%. But take a look at that gray line as well. The gray line, which is a little bit above the blue line, it shows a 3.3% inflation rate. That is what we call the core inflation. Core inflation is what the economists look at. They want to take a look at that number because that number takes away the more volatile item like food and energy prices. When you take out those, and more volatile item, it still stays at 3.3%. So we're still a little bit way to go before we get to the 2%, but we still believe that next year is going to get there. Now, take a look at the graph on the other side. That shows you the wage growth number. That is important because, of course, businesses, they need employees, they need workers. And if wages continue to rise significantly, that's part of the operation cost. If that continue to rise significantly, that factored into the operation cost. But take a look at that number. Even though that number may have spiked up a little bit recently, it actually has been continuously declining. Hopefully, it will continue to go back down, so it will keep operation costs down. Now, I think most of the increase in wages may be in the service sector, more so than in the goods sectors. And we'll talk more about that later. Next slide, please. Now, let's take a look at, let's talk about what happened. When the reason why I said everyone here has become an expert on inflation because inflation has an impact on interest rates. How have we been doing on interest rates? Now, it has been fluctuating. Take a look at the slide up there. I have two lines, the blue lines and the orange line. The blue line is a number tracked by Mortgage News Daily on a daily basis. I usually look at that number because, it's a little bit more sensitive on a daily basis. I want to look at it at a more real-time change. But if you look at the Freddie Mac's number, that's a weekly number. That's a lot of people look at that number because that's a number that's being quoted most of the time. But look at the blue line. The blue line, if you look at, where it was in October and September, October, at one point it actually dipped to a very low level, like maybe about 6.3, 6.1, 6.2, but then it started rising. What happened? The reason why it started rising is because the economy actually showing a little bit more stronger data. At the beginning of the, and I think in August and September, people were concerned about the labor market. Labor market is what the central bank looks at, and they think, well, maybe we need to actually do a little bit more rate cut. But then things actually start turning around, and we start seeing the numbers start rising. Now, the other reason why it started rising is as it got closer to the election, people started realizing that maybe the Republican Party, the President-elect Trump, could win the election, and that actually could boost the economy. And that's the reason why we actually start seeing the number going back all the way up to about 7.1.5% for the 30-year fixed rate. Now, you also will notice in the last couple of weeks, this number started coming down also. There have been a lot of things that happened in the last couple of weeks. One thing that happened was President-elect Trump nominated or actually suggested to have a candidate for the Treasury Secretary, Scott Bessent, I believe his name is. And he's a fiscal conservative person, which means he's not likely to spend a whole lot. And then when that happens, that actually means maybe the interest rate, the inflation rate may not necessarily go up that high. The economy may not actually go up as robust as previously thought, and people actually adjusted their expectation for interest rates. Next slide. And let's talk about the housing market and how it reacts to all those fluctuations. Now, I only have October's number. November's numbers will be released in maybe about a week, 2 weeks or so. If you look at the October's number, you can see that we actually started getting a little bit better. This is the October number, and when you look at the year over, the very first number that says 264,870, that's the number of sales of existing single-family homes. And that number actually show a very robust increase, almost 10% compared to last year. Now, I have to, there's a caveat. Of course, last year at that level, at the end of last year, the sales level actually was at a very low level. We're comparing to a very low base. So a 10% increase, actually, I was expecting a little bit higher. I was hoping to maybe see a 15 to 20% increase, but that didn't happen. But any slow growth counts. If you look at the year-to-date number, the number next to it shows a 1.7% increase, which means for the first 10 months, we actually increased by about 1.7%. Not significant, but we expect that number to continue to grow in the next couple months, maybe to 3 or 4%. We were expecting a 6% increase, but that might not necessarily materialize. Now, if you look at price, though, the statewide median price at the bottom, it says 888,740. It's very close to the 900,000 benchmark. We actually saw a 900,000 median price maybe about a few months ago. That's a very, very high number. Now, a few years ago, maybe 10 years ago, when people said, or maybe 20 years ago, when people say, hey, we bought $1 million house. $1 million house is a big house. But today, when you talk about $1 million house, it's probably just an average house. But it continued to grow. For one thing, though, if home prices continue to grow, that actually, maybe give people some confidence that market will continue to improve, and potential home buyers will come into the market, because obviously, if people think market prices are going to drop, they're not going to come into the market. So that's encouraging. It's not actually increasing sharply like 15-20%, but about 6% or so. That's partly because supply also have been moderating a little bit. Supply has not been as tight. If you look at that unsold inventory index, we're at 3.1 months of supply. It's still tight, but it's actually better. If you look at the year-over-year percentage, it's actually increased 14.2% or so. So things are actually moving along. We expect some of those numbers to continue to increase, and you will see those projections in a minute. Next slide. The high-end market, if we break it down by individual price point, the high-end market actually has been doing a bit better. And it has been doing better, not a surprise, because the more affordable segments, supply has been really tight. It's tighter than the more expensive areas. If you look at the expensive or high-end market, it's continued to grow by double digit, for area for price segments above 500,000 or 750,000. It continued to grow at a pretty substantial number. Now, that's also is because for people who are in the high-end market who are interested in buying high-end homes, they may not necessarily finance as much. They may have a little bit more equity. So interest rate may be a little bit less sensitive to them for a certain reason. But also at the same time, keep in mind, more likely people who are buying high-end homes, they more likely would have their investment in stock market, and the stock market actually has been doing a bit better. So that may actually have helped their wealth effect, improve their wealth effect. Next slide. But safe to say, in the upcoming year, as we move into 2025, things are actually going to get better for both the high end and the low end. If you look at, and then that's because of the interest rate that I mentioned earlier. If you look at the mortgage payment scenario here, this is a chart that shows you two lines, price growth compared to last year, and also price growth compared, or also mortgage payment growth compared to last year. At one point, if you look at that orange line, at one point in 2022, mortgage payment, because of increase in interest rate, it actually surged about 50% compared to the year ago level. That's significant. Just think about this. If you used to pay like $2,000 for a mortgage payment for the same home, a year later, a 50% increase means you pay $3,000. But take a look at that line. That line actually started dipping below zero in a few months ago. That means mortgage payment for the same house compared to a year ago is actually cheaper. So things are actually getting better. We hope that interest rate will continue to move down. That actually will help things a little bit. Next slide. And the other part of it, as I mentioned, is supply has been doing a little bit better too. If you look at the new properties being added to the market, if you look at that orange bar, all those charts with the orange bars, for the last few months, this is a year-over-year growth number. For the last few months, last 10 months or so, it actually has been increasing by double digit. So supply side actually has been improving. Now, we've talked about this before, or you might have heard about this before. Well, we call it the lock-in effect. That is, people lock in, current homeowners lock in at a 3% a few years ago, and they decided not to sell, partly because switching from a 3% mortgage rates to a 6%, if they were to switch up, they would have to actually lose money. They actually have to pay a lot more. There was a study that shows on average, people lose about $50,000 if they actually have to switch from a 3% to a 6% or 7% mortgage. So people obviously didn't want to do that, and that's lock up some of the supply. But things are actually getting a little bit better when you take a look at those numbers, partly because life has to continue. Life goes on, continue to go on, right? When you have a life event like you need to get married, you need to expand your family, you need to have a bigger house. So that's why people, when rates started coming down a little bit, and when the margin between what they paid for before and what they're going to be paying for eventually has narrowed, things actually get a little bit better. People put their house up in the market. Next slide. And the market competitiveness, because of increase in supply and demand, actually slowed down a little bit at the end of the year. Things actually have improved a little bit as far as market competitiveness. If you take a look at this slide, the share of homes sold above asking price actually has come down. That's great for potential home buyers. It's actually the lowest that we have seen maybe in the last 10 months or so, and it's lower than last year's level, which is encouraging. Next one, next slide. This is another slide that shows you, the market competitiveness as well. You look at the share of listings with reduced price. It actually has come down to maybe about 37.1%. It's pretty similar to last year's level, though. But if you look at how it compares to 2022 level, definitely has come down. So things are actually moderating a little bit. Of course, this is the end of the year, but even when we go into 2025, things are actually probably going to cool a little bit in 2025 as well, at least for the first few months before things start getting heated up a little bit when we get into the home buying season. Now let's take a look at the few slides with local statistics. And you can get, I'm only showing 4 slides of local statistics, but you can get all the statistics at the city level on the CRO website. I'll tell you at the end of the 4 slides where you can get some statistics. Now I'm showing Alhambra. If you take a look at Alhambra, the story is pretty much the same. Price, I think price for Alhambra actually dipped a little bit, but for the next couple of slides actually will increase. But I'm showing you the price here, the sales here, active listings, and market competitions measures. If you look at sales, for most sales, it's actually improved compared to last year. Now, Alhambra actually increased quite a bit, but take a look at those numbers. Those are actually very, very low number of observations, and that's why you're seeing, 180%. But most of them are probably maybe about, 10, 20% increase or so. But what you also should notice is the active listings. Active listings continue to increase by double digit, which is pretty decent. Next one. Next one is Monterey Park. As I mentioned, the home sales increase in Monterey Park, also 25%. Active listings also increased 91.7%. Part of it, is, of course, is because of inventory maybe demand slowing down a little bit, building up some inventory. Next one, St. Gabriel. St. Gabriel actually dropped a little bit in terms of supply, in terms of sales. Again, the number of sales drop seems significant, but that's partly because of the number of observations. But active listings also continue to rise. Next one, Temple City shows, actually this is the only slide or only city that shows a dip in active listings with sales and median price continuing to increase. Now, like I said, I'm only showing 4 slides here. There are a lot more cities on the CRO website. Just go to the market data section and go to the shareable reports, and you'll find more city level data. And we will have our November number out probably in about 2 weeks or so. Next one. Let's take a look at what we can expect in the upcoming year. Now, I already mentioned to you about the Black Friday sales that I said earlier. We have a 3% increase, 3.2% increase in economic growth. And that's because of everyone in here maybe participating in Black Friday sales. And we have, an increase in consumer confidence in the last few months or so. That actually boosted, people's ability to maybe at least, their sense of wealth has improved. So they actually maybe may have bought a little bit more stuff. And at the same time, we do have a shorter holiday shopping season this year compared to last year and a couple years ago because Thanksgiving started, late. So people may have actually started buying a bit more aggressively in the last couple of days, in the last couple of weeks or so, and retailers have been actually pretty aggressive in terms of their accounts, in terms of the discount. So maybe that might have actually promoted more sales. Next slide. So let's talk about, now that's the short term. Let's talk a little bit about the longer term. What can we expect, in the economy? Now, with the new administration going to be in place in 2025, and also the Republican Party actually taking over both the Senate or controlling both the Senate and the House, we actually could have a bit more tax cuts in the upcoming year, which is what President-elect Trump campaigned and mentioned that they will have more tax cuts. With more tax cuts, we have seen something similar. With more tax cuts, people have more money in their pockets. They'll probably spend a bit more. But there are other things that people need to consider and look at it also. A few years ago, we have the SALT and the mortgage interest deductions being one of the big things in the tax reform. Those may actually be revisited, and that could actually put a little bit more money in people's pocket as well. Now, I'm not going to talk about all those others now. I'll talk a little bit about inflation later. Next slide. So based on just what I said earlier, as far as the economy is concerned, if you look at the 2025 numbers, in terms of the economy, we expect not a significant growth in terms of the economy, but a 1.1% increase in economic growth. I know that number is a little pale compared to what we have seen in the past 2 years. Now, it is possible that the number could actually increase a little bit more. I have to admit that number was predicted or projected before the election. So the number could actually increase slightly to a more positive number. Now, I used to think, a few months ago that, we may still have a recessions in the first quarter or second quarter of next year, but the chance of having a recessions in the first and second quarter of next year may actually be a little bit slower. But here's the thing, if we actually have, and I'll talk about the tariff part of it, if we actually have tariffs in place in the first half of the year, there's a possibility that we may actually see some slowdown in the second half of the year, maybe in the third or fourth quarter. Not only the U.S. economic slowdown, but also a global slowdown. Take a look at unemployment rate. We do expect unemployment rate to actually increase to 4.4% next year. Most likely, that increase will take place maybe in the second and starting in the mid of this next year, and then going into the second half of 2025. CPI number, we do expect that number to continue to drop. I am actually expecting that number to be a little bit higher than the 2% that I predicted earlier because of the tariffs effect. Next slide. This is kind of, before that, California outlook. Here's, what might happen to California. If you take a look at non-farm job growth, it's still going to be positive at 1.1%, but unemployment will inch up a little bit to 5.6% in 2025 compared to 5.4%. Now, 5.6%, of course, is a little bit higher compared to the last few years, but it is still not a bad number. But we do expect that number to continue to inch up a little bit. Next slide. Let's talk about the housing market outlook. What can we expect from the housing market? Now, if we want to take a look at housing market, then of course we need to look at how consumers think about, their the economy as well as the market. You're going to see the purchase sentiment from the buyers. You're going to see, I think I have a seller sentiment as well. If you don't have a seller sentiment in the slide, I'll verbally talk about it a little bit. First, the purchase sentiment. Buyer sentiments actually continue to improve. If you look at the blue line right there, the blue line with the dot that says good time to buy. If people think it's a good time to buy, they're more inclined to buy, right? Take a look at that number. Even though it's not a huge number, it's not a significant increase, it actually increased from 17% to 18%, from 19% to 20%. So it continued to inch up. So people are feeling a little bit more confidence about the housing market, partly because they might be settled with, the fact that interest rate may not actually go down that fast, but interest rate will actually go down. So it's start inching up a little bit. That's a good sign. Next slide. And it actually translates into actual pending sales. We actually have been collecting MLS data, pending sales, open escrow sales. You probably know firsthand more than I do that open escrow sales at the state level actually increased by 20% now compared to last year. If we look at last year's level, like I said, last year was not a great level to begin with, but hey, we'll take whatever we have. It's going to increase by 20% if it translates to closed sales, it might actually increase about 20%. So that's a good sign. And we have already seen some numbers on mortgage applications at the national level that actually has been increasing on a weekly basis as well. Next slide. And the reason why people actually believe or actually are more confident about the market is because of consumers believe that interest rate will go down. Now, it actually fluctuated in the last couple months or so, but take a look at the blue dotted line again. The blue dotted line shows you what respondents or what consumers think about the mortgage rates, whether it's going to go down or it's going to go up. The blue line shows going down, and you can see the last few months. I know it's a little hard to look at. It shows that in the last few months, it's fluctuating at around 40%. It actually did go up to 42%, meaning 42% believe mortgage rates will go down. And actually it dipped a little bit to 39%. That's because of what happened in October. We actually saw rates actually surge to a higher level. But remember what I said earlier, last 2 weeks, mortgage rates actually started coming down. So next month, we may actually see that blue dot line start coming back down. Next slide. And how much time do I have? Maybe... Okay, I'll quickly wrap it up. Sorry. Now, here are the things that we want to focus on. The question is, what can we expect for interest rates? There are a lot of speculation, but based on the Federal Reserve predictions, we actually will see about a 75 basis point dip in interest rates in the upcoming year. That is encouraging. That's the reason why. That's the reason why we're actually seeing some dip, or expect a dip in interest rates. Next slide. Now there is a difference between before and after elections. As I mentioned, after elections, we are actually less. We're a little bit more concerned about inflation, and that's the reason why the interest rates actually have come down. The odds of having rate cuts actually have come down a little bit. In December, if you take a look at those numbers, it's expected to have a 25 basis point rate cut. But if you look at how it compares to the light green bar and the darker green bar, if you look at how it compares between each other, the number of probably actually has come down from 82% or 83% to 74% as far as rate cuts. So that's the reason why, the reason why that is the case, next slide, is because of inflation. Inflation is generally believed that is going to be a little bit more in 2025 because of tariff, but probably because of tax cuts too. Now, when the economy is actually a little bit more robust, inflation tends to flare up a little bit more. Tariff is basically a tax. If we put a tax on our products, imported products, and we all know how many imported products we have, from China, from Mexico, from Canada. When we put a tax on it, that usually means consumers are paying for it, and that's essentially an inflation. When we have more inflation, of course, the Federal Reserve are not going to cut rate more as aggressively as previously thought. Next slide. I'm going to skip this one. And now here's another thing to keep in mind. When we have tariff, of course, tariff is applied on imports goods. If it affects the economic growth in those countries, including Mexico, Canada, and China, most likely their currency is not going to be as strong as the dollar, as the U.S. dollar. That also means the U.S. dollar is a little stronger. And then you can sort of get a sense of how it affects foreign buyers. Many of you might have dealt with foreign buyers, might be dealing with foreign buyers. If it costs more to buy in the U.S. than in their own country, that might actually affect their desire to buy in the U.S. So that actually could have an impact. Next slide. The last slide, I'm just going to generally talk about this, and I know I exceeded the 1 minute, but I'm just going to generally mention this. Insurance, of course, is an issue. Insurance actually has been an issue for the last couple of years. If you take a look at the all column, 16% of the buyers last year meaning 2023, said they actually had difficulty obtaining insurance. That number jumped to 31% this year. And it's going to continue to be an issue. If you go to the next slide, you see that, or the one after that, you see that we expect at the national level, it is expected to increase as far as insurance costs is concerned. This year, it's expected to be increased by 14%, but next year and the year after that, it will continue to increase by 9.5% and 8%, and that is going to have an impact on home buyers as well. Next slide. We'll just skip that one and then go to the next one after that. Of course, I have to wrap it up with the seller sentiment. Sellers, are they going to put their house up on the market? Like I said, they are going to put their house up on the market, but it may actually be a little bit slower than what we previously expected. That number should improve though in 2025, and hopefully we'll get back to 65, 66%. Next slide. And this is the predictions for next year. For sales, we expect a 10.5% increase in sales for existing single-family homes. That I'm pretty sure we won't get to 10%, but at least 8 or 9%. Median price, it's going to be moderate, 5% or 4.6% in 2025. And 30-year fixed rate, it's going to get to close to 6%, most likely 6.2% now, because I think tariff is actually going to have an impact. And with that, the next few slides, okay, this is just a summary of what I mentioned before. The economy is going to do okay. Inflation will continue to flare up. Price, as far as sales is concerned, we're going to see a moderate high single digit or maybe double digit increase in sales. Price wise, it's going to be a 5% increase, and inventory, it's going to be about 10 to 20% increase as well. There are going to be issues, insurance policies, geopolitical tensions, and of course, stock market volatility as well. The rest of the slides are just marketing stuff. But if you fast forward to the very, very last slide, it should have my contact information. And I'll be posting this presentation.
Thank
Thank
you so
you.
much. I apologize. We don't have time for questions, but Oscar will be here after the meeting for any
Hold on, hold on.
in-person questions.
And in appreciation of your appearance today, here's a token of our appreciation.
Thank you very much.
And next Thursday is our last meeting of the year. We're gonna feature our holiday breakfast, and also we're gonna have a farewell to Ling Chao, our president. Okay, 2023 and 2024. We're gonna have a farewell for her, and so please come back and join us 8:30. Okay, we're gonna have a Christmas celebration. Okay, thank you very much for joining us today, and the meeting is now adjourned.